In the first quarter of 2025, global equity markets experienced persistent volatility shaped by a complex mix of macroeconomic dynamics, shifting political landscapes, and ongoing adjustments to monetary policy expectations. Amid this environment, our investment philosophy, anchored in identifying great businesses with exceptional management and attractive price, has remained unchanged. This consistent approach continues to guide my portfolio decisions to support the fund's long-term performance objectives. Japanese equities started the year on a positive trajectory, supported by several structural and cyclical tailwinds. Domestically, ongoing improvements in corporate governance and more shareholder-friendly capital allocation policies enhanced investor confidence. Externally, the relative undervaluation of Japanese equities versus US markets has attracted renewed interest from global investors seeking diversification and value. The market also responded favorably to signs of economic normalization. The Bank of Japan's cautious policy normalization path, combined with improving corporate earnings, has created a constructive backdrop for long-term equity investors. Within this framework, my focus remained on high-quality companies with resilient business models, global competitiveness, and clear growth drivers. Hitachi has steadily built momentum in areas aligned with structural growth, particularly in energy and infrastructure. The company's power grid solutions are seeing increasing demand amid the global push for decarbonization and AI-led digital infrastructure. Its transformation into a streamlined, tech-enabled conglomerate is gradually being reflected in improved market valuation. Similarly, Keyence, for example, continues to demonstrate strength in its niche of factory automation. Its sensors and control equipment offer cost efficiency and productivity enhancements to clients worldwide, characteristics that are particularly valuable in a high-cost, high-rate environment. With high margins and a capital-light model, Keyence remains a long-term holding. Throughout these months, I resisted the temptation to chase market momentum or speculative narratives. Instead, I continued to emphasize long-term positioning. This includes identifying companies with defensible moats, diversified revenue bases, and management teams capable of navigating complex environments. One such example is Shin-Etsu Chemical's PVC business. With a fully integrated supply chain within the United States, Shin-Etsu is well insulated from the uncertainties of international trade policy, making it strategically attractive in today's fragmented global landscape. In March, a noteworthy development came from SPARX, following a small analyst meeting held with key market participants. Chairman and CEO, Mr. Inoue, and new President and COO, Mr. Takahashi, articulated a renewed strategic direction for the firm, emphasizing a pivot towards fee-based businesses and scalable capital-light models. The firm's target of achieving 11% ROE within 3 years, coupled with a 10% plus EPS growth goal, demonstrates a clear commitment to improving shareholder value. This is supported by continued share buybacks and a stable dividend policy, offering a total capital return yield of nearly 6%, including dividends and repurchases. Crucially, SPARX is aiming to grow third-party capital management in private equity, infrastructure, and private credit, while gradually reducing its reliance on capital-intensive principal investments. This transformation suggests that the market should no longer value SPARX purely on the price-to-book or net asset value basis, but rather on the price-to-earnings multiple over time in line with global asset management peers. If SPARX can successfully build out permanent capital pools and stable recurring fee income, the re-rating potential should be significant. Global peers such as KKR and Blackstone are often valued at multiples far higher than the sub 10 times price to earnings currently applied to SPARX. From a value investor's perspective, this represents a compelling mispricing with substantial upside potential. Given the recent market volatility sparked by political headlines and trade rhetoric, I feel I have to say something on this topic to address the Trump administration's evolving economic policy direction. While media commentary has largely focused on the perceived one-sidedness of tariff policies and rising protectionism, I view the underlying strategy as more nuanced. The US faces a growing budget deficit and ballooning national debt, trends that have accelerated in recent years. The risk of a debt spiral where rising interest costs exacerbate deficits in a self-reinforcing loop has become more tangible as market rates continue to rise. In response, the Trump administration has outlined a multi-pronged plan, streamline public spending, reduce taxes, boost private sector vitality through deregulation, lower energy costs, and implement tariffs. Each measure is interconnected. For example, while tax cuts may reduce immediate revenue, the administration is betting on higher potential GDP growth from deregulation and reindustrialization to offset the fiscal impact. An interesting initiative is the Department of Government Efficiency, or DOGE, led by Elon Musk. DOGE is tasked with identifying redundant government expenditures and inefficiencies, including outdated IT systems and questionable pension claims. On trade, tariffs are being reframed not merely for a singular objective, but as instruments for rebalancing long-standing asymmetries. For decades, US tariffs on imported goods have been significantly lower than those imposed by trading partners, often due to post-World War II recovery agreements that no longer reflect current economic realities. The move toward reciprocal tariffs, where the US matches the rates imposed by its partners, is aimed at leveling the playing field and restoring domestic manufacturing competitiveness. There's also a national security dimension. Restoring industrial capabilities in sectors like shipbuilding and semiconductors is increasingly seen as critical for strategic independence. For example, the US shipbuilding industry has shrunk considerably compared to China's. Tariffs combined with a shift in policy incentives may accelerate the return of manufacturing and supply chains to American soil. Unlike the Biden-era CHIPS and IRA subsidies that offered carrots to foreign companies, Trump's tariff-based approach uses sticks, raising the cost of import dependence and nudging firms to localize production. If successful, this may result in job creation and greater tax revenue, either directly through duties or indirectly through domestic investment. For the fund's portfolio, the implications are measured. Many of the holdings, such as Recruit Holdings and Tokyo Marine, are service-oriented and not exposed to manufacturing-based tariff risks. Meanwhile, manufacturing names like Keyence, Hitachi, and Shietsu have mitigated geopolitical risk through either geographic diversification or localized operations. Looking ahead, I remain optimistic yet cautious. While markets may continue to react to short-term news flow and policy shifts, I believe the path to value creation lies in disciplined, long-term investing. My strategy focuses on identifying businesses with sustainable competitive advantages, strong governance, and the ability to grow earnings regardless of macro headwinds. Companies that are proactive in adapting to change, whether through technology, capital allocation, or global positioning, are well suited to deliver resilient returns. In this context, I believe that Japanese equities remain particularly attractive. Valuations are still undemanding, governance is improving, and the market offers differentiated exposure to global trends through companies with world-class capabilities. Berkshire Hathaway's continued interest in Japanese trading houses is just one indicator of this renewed global confidence. As always, I will use market volatility as an opportunity to sharpen our focus, revisit my assumptions, and deploy capital into businesses that can thrive over the long term.